No audit is fun, but an audit where do you want to get audited? Wave a big red flag at the IRS. Here's 5 big red flags for the IRS. They're things that they look for in particular. But just because you have one of these, if it's legitimate, you really shouldn't worry about it. These are general things, and depending on the type of your business, they may not be a red flag. But if you're doing any of these things and you're not positive you can justify it, maybe get a little less aggressive. Number 1, excessive meal expenses. If you are claiming thousands of dollars in meal expenses every single month, you probably are waving a red flag at the IRS. It's pretty hard for most people and most businesses to justify either the amount of that expense or that many business meals. Now, if you're a traveling consultant who is on the road for 300 days a year, yeah, you're going to have a lot of business meals. If you're a marketer, you might have a lot of business meals. But for most people, pigs get fat, hogs get slaughtered. Be reasonable. Number 2, any sort of 100% use of personal assets. If you're claiming 100% of your phone, your vehicle, or your business, of your internet for your business, you need to be careful. That's especially true if you're a sole proprietor or you work from home and you don't have another one of these things. So you can very easily write off 100% of your business phone if you have a personal phone. And it's pretty easy to write off 100% of your business vehicle if you have a personal vehicle. I have clients who actually do have a separate internet plan for their business in their house than their personal plan. But if you're not doing that, you probably shouldn't be claiming 100% of any of these things. It's a huge red flag to the IRS. And yeah, especially with the vehicle, they can definitely tell. Number 3 is very large deductions for travel. If you have frequent travel, and again, $5, $10, $15, $20,000, especially if it's year after year, especially if you're not in an industry that it makes sense to have lots of travel, that's a red flag because the IRS is now suspecting you're writing off personal vacations. Now, you can have fun on a business trip. You can kind of make a vacation out of it, but you don't want it to be a vacation. You want the travel to be for a business purpose. If you waive this red flag, you better be able to justify all those trips and all the expenses on those trips. And by the way, related to meals above, if every time you go out to Olive Garden when you're home, you spend $20 or $30, and every time you go out to dinner when you're on a business trip, you spend $100, they'll check that, they'll find that too, and they're going to argue in many cases that that's not a reasonable expense because you're overspending on your travel. So again, if you're a traveling consultant, traveling salesperson, you're going to have a lot of travel, and that's fine. But if you're somebody who is probably doing 95% of your work via Zoom at most, watch out for the travel. Try to limit it to 3, maybe 4 trips a year. Another big red flag can be unusually high deductions for your income level. If your income is $1 million and your expenses are $950,000, that's usually going to be a red flag. Now, again, it's going to matter what business you're in. If you're in some sort of a consulting business where you kind of are the product, massive red flag, welcome to Auditsville. If you are a retailer doing fulfillment by Amazon, your margins may be that thin. Hopefully they're not, but at least that's something that's justifiable. Make sure that your deductions are reasonable based on your overall revenue. Also, make sure the other categories are reasonable based on your overall level and your expenses are reasonable. If you go out and buy a $10,000 computer because it's really cool and really fancy, you better be able to justify that if the IRS asks, why did you need that $10,000 computer? The really nasty thing about this red flag is usually the IRS is going to assume that you're underreporting income as opposed to inflating expenses. That's when they really start raking over the coals, demanding lots of documents, completely invading your privacy. No audit is fun, but an audit where they think you're seriously underreporting your income is pretty much a worst case scenario. The final big red flag is claiming losses overall multiple years in a row. This is especially true if you also have W-2 income. If you have a day job and you're making good money and you have a side hustle and you're losing 5, 10, 15, $20,000 year after year after year, that's probably the best way to get audited other than screwing up your S-corp compensation. Because that shouldn't happen if it's a business. The IRS sees that after 3 to 4 years, they'll typically come in and say, that's not a business, that's a hobby. Hobbies are terrible because if you have income from a hobby, you owe income tax on it, but you get no deductions. I've seen people with hobbies making $40,000 a year and spending $80,000 a year. I would not want to pay tax on $40,000 extra without getting to deduct that $80,000 in expenses. Now, as with everything else, there are exceptions to this. Real estate is the biggest example. It's very common for real estate investors, especially buy and hold, to have paper losses due to depreciation for years and years and years. But in general, in most businesses, the IRS wants to see you profitable 3 out of every 5 years, and you better be able to justify it if you don't. Thanks for listening. Hope you save a lot of money.